Hello, we are Group 5, and today we are going to evaluate the following companies for its financial health. We're going to be looking at Starbucks, Texas Roadhouse, Nestle, Chipotle, and Kraft Heinz Company. The ratios that we are going to be using is the operating profit margin, which is going to show us how efficient these companies are at making a profit. We'll be looking at the debt to asset and the debt to equity ratios, which will show us how much debt a company is using to operate. Now, obviously, the lower the debt, the more leverage a company will have. And finally, we will look at the return on invested capital. It will show us how efficient a company is at obtaining capital. So let's dive into these findings.
Texas Roadhouse has demonstrated strong financial performance with its ROIC rising from 10.91% in 2021 to 16.23% in 2023, supported by revenue growth of 15.36% in 2023 and a projected 13.19% in early 2024. Equity has grown from $1.028 billion in 2022 to $1.158 billion in 2023. Reflecting reinvested earnings and financial stability. However, its debt-to-equity ratio has increased from 0.42 to 1.41 over the same period, signaling a higher reliance on debt, which introduces risks during unfavorable economic conditions. Operationally, Texas Roadhouse continues to improve profit margins and maintain consistent quality, setting it apart from competitors in the casual dining space. It effectively manages costs and prioritizes customer loyalty and engaging experiences. For long-term investors, Texas Roadhouse offers significant growth potential, while short-term investors should monitor valuation and economic trends. Despite risks tied to debt and economic cycles, this company's strategic reinvestment and stable expansion position it well in the industry.
In 2021, Nestle had a strong year with 7.5% organic growth and 5.5% internal growth. This was thanks to high demand for coffee, pet care, and nutritional products. E-commerce also stood out, making up 14.3% of total sales, showing how well Nestle adapted to online shopping trends. Things got tougher in 2022 when inflation hit. Nestle had to raise prices to keep up, but they didn't lose focus. They kept working on new ideas and improving sustainability, which helped make their products and operations better. These 2 years showed how Nestle managed both success and challenges by staying adaptable and focused on long-term goals.
In 2023, Nestle faced a leadership shakeup with a new CEO stepping in. This happened during a tough time. Sales growth was slowing and competition was heating up. To respond, the company emphasized pricing strategies to keep customers engaged. They also acknowledged that earlier pricing hikes had hurt their sales volume. Overall, from 2021 to 2023, Nestle had to navigate a lot. Global inflation, industry shifts, and internal changes. Despite the ups and downs, their focus on digital transformation and sustainability kept them competitive. Looking ahead, they still need to tweak their strategies to stay on top. Right now, holding stock position seems wise, but it's probably not the best time to invest in new shares until market conditions improve.
So I'm going to talk about Chipotle and how their financial health has evolved over the past 3 years. The company has done an incredible job improving its overall financial stability, growing both its assets and net income. They've managed to keep liabilities in check while significantly growing their profitability. An example of this is their return on invested capital, or ROIC, that had an amazing jump from 9.12% in 2021 to 14.23% in 2023. That shows they've gotten a lot better at investing their capital to generate returns. Even their debt to asset improved, moving from 0.65 in 2021 to 0.62 in 2023, which shows strong financial stability. So now let's talk about the things that Chipotle's done to achieve this growth. Between 2021 and 2023, they've raised their prices to deal with rising costs for their key ingredients like avocado, cheese, and sour cream. Even though a price hike can sometimes scare off customers, Chipotle's managed to maintain strong loyalty, especially amongst health-conscious like Gen Z and millennials target market, according to the New York Post. And their efforts paid off. Their net income almost doubled during this period, going from $653 million in 2021 to a $1.23 billion in 2023. That's a big win driven by higher revenue and smarter cost management. Another area where Chipotle has really stood out is digital sales. Their investments here caused some of the highest margin sales for the company, which is a big deal. Plus, their rewards program has been a big game changer with 40 million members contributing to their success. And let's not forget their global expansion with several different stores opening around the world, helping Chipotle grow its footprint and remain competitive. All of this has caused Chipotle to be the best operating profit margin among its competitors, and they're doing it while reducing their debt year after year. While there's a lot to admire about Chipotle's financial performance, our group has decided that we wouldn't buy more stock right now. The main reason for that is that their stock price is really high, which makes it vulnerable for market corrections. This kind of volatility can make it a risky investment. On top of that, the rising cost of their key ingredients continues to put pressure on their margins, which could eventually impact their demand. So in summary, Chipotle is definitely a strong, growing business, but it's not the best stock investment right now.
Over the past 3 years, Kraft Heinz has focused on stabilizing its financial health by reducing debt and achieving the most modest profitability growth. The company has consistently lowered its debt-to-asset ratio while improving its return in investment. This shows a more conservative financial structure aimed at long-term stability. However, Kraft Heinz ROIC is at 3.16%. It is the lowest among its peers. Competitors like Starbucks and Texas Roadhouse have achieved much higher ROIC by focusing on innovation and expansion, such as premium offerings and digital platforms. Meanwhile, Kraft Heinz has prioritized cost-cutting and portfolio restructuring, including entering the plant-based food market through its partnership with Notco. While these steps have improved efficiency, they've also slowed revenue growth. In terms of performance, Kraft Heinz is underperforming compared to its peers. It has reduced liabilities and improved profitability, making it a safer investment during uncertain times. However, its lower ROIC and limited growth potential make it less attractive to new investment. If I owned Kraft Heinz stock, we would hold it, but we wouldn't purchase additional shares right now. In summary, Kraft Heinz is a stable company with strong financial management, but it lags behind its competitors in growth and innovation. While it's a solid long-term investment option for cautious investors, there are better opportunities in the market for those seeking higher returns.
Starbucks is an American-made company based out of Seattle, Washington. They currently hold domestic and international offices, and as of November 2024, they hold 1.13 billion shares. Now, the market cap is $113 billion, and out of those, they make approximately 32% on profit per share. Now, in the current times, due to lower foot traffic, the domestic branches, and due to the social, political, economical changes, that's causing the year-over-year net growth to be only 10%, which is just under the 12% market cap for this industry. As we look at the return on invested capital, we can see that it's the highest among the peer companies, coming in at 19%. Now, the average percent for that is 10. However, when we look at the weighted average cost of capital for December 2024, it is at 8%. Therefore, it's showing that the trajectory is headed in the right direction for this company. When we look at the debt to equity for this company, it is negative, coming in at negative 4.69. That is an alarming rate, as it is showing that the company is currently carrying a ton of debt. However, Extensive share repurchases using profits and borrowed funds causes this company's liability to increase, but at the same time, it is also causing the increase in assets. That also then turns the debt-to-asset ratio to be 1.27, which is almost double the market average of 0.55. Customer loyalty is one of the keys to Starbucks' success. Customers are willing to pay a premium for a coffee, which is why the operating profit margin for this company is increasing about 14% year over year. Now in 2024, Starbucks opened 614 domestic coffee shops. That totaled to about 18,000 total coffee shops in the United States, and they also have approximately 21,000 coffee shops throughout the world. Now this ever-expanding franchise, both domestically and internationally, is what has kept Starbucks at the top of investors' minds because of the fact that it has a relatively low volatility in the open market. Now, Starbucks does operate with a high debt ceiling in its day-to-day operations. However, it is also increasing in its assets year over year. Now, Starbucks is in a strong position to capitalize on expanding customer base and operational efficiency. Starbucks is very well equipped at the moment to navigate the social, political, and economical issues that are going on in the world, and therefore we believe that it can sustain a positive growth trajectory throughout the market. Therefore, it is a good company to currently invest in.
Through its partnership with Netco, I don't know.
Evolved over the past 3 years. Their return on invested, okay.
Maybe sit up and like talk from your diaphragm. Because maybe when you slush, you're not.
Can you lower it a little bit? There you go. Because I'm doing like.
Yeah, like you're like almost.
Texas Roadhouse, Nestle, Chipotle, and Heiss.
I didn't even say what I said the first time. I was like, right now. Do I sound like a cat? Right, meow. Right now, stock. Oh my gosh. Right now, I can't say that one sentence. Dang it. Right now, holding stock.
In 2021, Nestle had a bitch. I was ready. 21. Nestle has a. I can't. That was weird.
A revenue growth of 16. Wait, can I start over?
Oh, I love that. Yes, keep that going.